In this video, I will be discussing interim acquisitions and the statement of cash flows. One last complication we haven't considered is that it's unlikely every business combination is going to happen on January 1st. FASB requires that the consolidated financial statements contain the subsidiary income only from the date of acquisition on. In order to accomplish this, we will treat any income earned before the acquisition date as equity. Let's look at an example. In this example, we have Pool Company purchasing 80% of the common stock of Sun Company for $50,000 on an interim date of July 1st, 2015. Additional data concerning Sun Company for the year 2015 are presented below. So we have common stock, other contributed capital, 1/1 retained earnings, net income, and dividends declared. Any difference between book value and the value implied by the purchase price relates to Sun Company's land. Pool Company uses the cost method to record its investment. Prepare the workpaper entries that would be made on a consolidated statements workpaper for the years ended December 31st, 2015 for Pool Company and its subsidiary, assuming that Sun Company's income is earned evenly throughout the year. Okay, so we are going to assume that the subsidiary does not close its books at interim unless otherwise stated. So that's a thing that could happen. We could have our subsidiary actually close their books, and then that makes the accounting a little bit easier. So we're going to learn it the harder way. All right. So we're going to start with our computation and allocation of differences schedule because that's pretty much always where you should start. So our ownership percentage is 80%. Our non-controlling shareholders then have 20%. Those have to add up to 100. Our purchase price, they told us, was $50,000. So that is going to go right here. Then we're going to extrapolate by taking our purchase price, dividing by 80%, which gives us the implied value of the entity as a whole. We're going to multiply that by 20% to get the value of the non-controlling shares, which is $12,500. We're then going to calculate the book value of the entity by adding up all of their equity accounts. So they had common stock, as we see up there, of $25,000 at the date of acquisition. They had other contributed capital of $10,000. And now they hadn't closed their books as of this interim date. So their retained earnings is a little bit out of date. It's from the beginning of the year rather than our date of acquisition at $10,000. So the way we're going to remedy this is we're going to count any income earned by the subsidiary before the date of acquisition as equity. So we're going to add a line to our computation and allocation of differences schedule called subsidiary income purchased. Now, we're assuming that they earned their income evenly throughout the year. And since 6 months have passed, that means we can take this net income number, divide it by 2, and that's the income that would have been earned prior to the acquisition date. So now we're going to add these guys up. And we get a book value of $57,000. Going to compare that to our implied value, which gives us a difference between implied and book of $5,500. So they would like us to prepare the eliminating entries for the first year end. So at the beginning of the year, January 1st, we were not a consolidated company. Then midway through the year, July 1st, we purchased our subsidiary, and that was when the requirement to consolidate kicked in. And now we've hit the end of the year, December 31st, and it's our first year putting together a full set of financial statements. But remember, we're only going to count the subsidiary income from the date of acquisition through the end of the year. So we're just going to work our same steps. First, we're going to talk about eliminating any intercompany transactions. Again, we don't have any, just reminding you to keep an eye out for them. Then we need to eliminate any current year income of the subsidiary recorded by the parent. So they told us that our parent company uses the cost method. So we know there's not going to be any income that they recorded because they don't do that under the cost method. That's the equity method. However, we do now know that under the cost method, sometimes we have to establish reciprocity instead. But since this is the first year, we don't have to do that. Now, if you tried to do it, you just kind of got confused and you're like, okay, I know it's the cost method. I have to do reciprocity. You could do it, but your entry would end up having a value of 0. So that's how you would know that you didn't need to do it right now. So this is NA. Then we need to eliminate any dividends paid from the subsidiary to the parent. So during the year, the subsidiary did pay dividends, and they paid them after the acquisition date. So remember, our credit is always going to be dividends declared by our subsidiary, and our debit is going to depend upon whether the parent company is using the cost or the equity method. So in this case, it's the cost method. So when we receive those dividends, we would have recorded them as dividend income, which means we need to eliminate dividend income. The amount of those was $2,000. 80% of that came to us. So that means we recorded dividend income of $1,600, and we need to eliminate dividend income of $1,600. Our next entry is our entry to eliminate our subsidiary equity. So again, I'm going to do the account names, then we'll come back and fill in amounts. So we're going to start with investment in S to get rid of our asset account. Then we're going to debit all of the equity accounts of our subsidiary. Common stock of our subsidiary, other contributed capital of our subsidiary, 1/1 retained earnings of our subsidiary. And here's the new part. We need to make sure that we include that additional income in this entry, or things aren't going to make a lot of sense. So we're going to put subsidiary income purchased. So you might already be thinking about, wait, where does this go in my worksheet? How does this work? We won't be doing that in this class, so don't worry about that. Just remember that we need to put subsidiary income purchased in our eliminating entry. Okay, so we've got all of our subsidiary equity and we've got our asset account. Now, since we don't own 100%, we're going to need a non-controlling interest. And because we did not purchase this company at book value, we're also going to need a difference between implied and book. Our difference between implied and book is positive, so that means in this entry it will be a debit. Okay, so our difference between implied and book is calculated on the date of acquisition and doesn't change, so we know that one's going to be good. Our common stock and other contributed capital, we also know aren't going to change just because our book is nice to us. Then 1/1 retained earnings, in this case, 1/1 is, so 1/1 of the current year is the number that's in our computation and allocation of differences schedule. So we can use that one as well. And the amount of subsidiary income purchased is also in our computation and allocation of differences schedule. So since all of our debits came from our computation and allocation of differences schedule, all of our credits can as well. So our investment in S will be our original investment of $50,000, and the non-controlling interest will be our original calculation of the value of their shares, which was $12,500. The only thing left to do is allocate our difference between implied and book, which was $5,500. And we need to head back up here and look for some evidence of what that would be. And they tell us that any difference between the book value and the value implied by the purchase price relates to Sun Company's land. So they're telling us that entire difference between implied and book should go to a fair value adjustment to write up land. So the only real difference here is that we need to remember in an interim acquisition to treat any income earned before the acquisition date as subsidiary equity. If we don't do that, our calculation of our difference between implied and book is going to be incorrect. Our last loose end is the statement of cash flows. At the beginning of this chapter, I told you we needed to prepare a full set of financial statements, and then promptly proceeded to ignore the statement of cash flows. The preparation of the statement of cash flows is done using information from our consolidated income statement and our consolidated balance sheet. Therefore, no new eliminating entries are required to prepare the statement, and the parent's method of accounting for the investment doesn't matter. For this class, we will not be preparing statements of cash flow, but we should know a few things about them theoretically. When presenting a consolidated statement of cash flows, we have the choice to start either with the consolidated net income or with income attributable to the parent. The financing activities section must include any dividends paid by the subsidiary to the non-controlling shareholders, because this is a cash flow that is leaving the consolidated entity, unlike dividends paid to the parent. The parent company's initial investment in the subsidiary is sometimes a cash flow. It depends on who is receiving the cash. If the stock is purchased directly from the subsidiary, then no cash leaves the consolidated entity. However, if the shares are purchased on the open market, such as in a hostile takeover, then the cash is leaving the consolidated entity and would be considered an investing cash flow. This concludes our discussion of interim acquisitions and the statement of cash flows. Don't forget to email your questions for our discussion.